Welcome to Monthly Indonesia Economy Focus. This is Solo Audio Podcast. Today we're diving deeper than surface numbers. We're here to understand the structural forces that truly drive Indonesia's economic trajectory. August 2025 was, well, let's call it a month of fascinating contradictions. Strong GDP growth? Absolutely. Manufacturing rebound? Check. Bold new trade and energy initiatives? Yes. But here's what makes this complex. Rising social unrest, governance scandals, and persistent structural weaknesses that experts warn could undermine our long-term progress. The headline story sounds impressive. Q2 GDP grew 5.12%. Manufacturing PMI jumped to 51.5. Bank Indonesia cut rates to 5% amid mild deflation. Investments surged to $57.38 billion in just the first half. That's nearly 4 times what many analysts expected. But beneath these numbers, that's where the real story lives. As Denny Fryowen from CSIS Indonesia put it, Indonesia's Q2 growth is strong in headline terms, but its foundations are fragile. He's warning us about what he calls a paradox of productivity. Massive capital inflows pour into mineral processing and downstreaming. They create impressive GDP numbers, yes, but they're failing to generate proportional employment. That's the tension we need to understand. Meanwhile, the streets tell a different story. Nationwide protests erupted over parliamentary pay hikes and a fatal police incident. The KPK arrested the deputy manpower minister in a corruption case. And here's the stark reality. 22,671 manufacturing jobs disappeared in the first half of 2025. That's more than half of all 42,385 layoffs across every sector. Despite those record investment flows. Yet amid this turbulence, something strategic was happening. A groundbreaking trade deal with Peru, major progress on the Abadi LNG project, rapid expansion of local currency transactions. Early 2026 budget planning. These moves signal Indonesia's push toward greater economic sovereignty. Today, we're exploring 4 critical questions. Why does record investment mask a productivity paradox that threatens inclusive growth? How does fiscal and monetary policy incoherence create a liquidity trap? What's the strategic significance of these new trade, energy, and financial initiatives? And is social unrest just political noise, or a crisis of fiscal legitimacy that markets now watch as a core economic variable? Let's dive in. August opened with Q2 GDP numbers, 5.12% year-over-year growth, up from 4.87% in Q1. Fastest pace in 2 years, beat market consensus of 4.8%. Strong performance by any measure. But here's what CSIS Indonesia's analysis reveals. This growth embodies what economists call premature deindustrialization. That's when an economy shifts toward capital-intensive sectors before achieving full employment in labor-absorbing manufacturing. It's a critical distinction that changes everything. Private consumption grew 4.97%, supported by government stimulus like the 13th month salary and social assistance. Still below pre-pandemic averages of 5.2 to 5.4% though. The real surge came from investment, 6.99% year-over-year, fastest pace in 4 years. Here's the scale we're talking about. Total realized investment in H1 2025 hit 942.9 trillion rupiah, approximately $57.38 billion. This wasn't incremental growth. This was massive capital influx. Foreign direct investment reached 432.6 trillion rupiah, slightly trailing domestic investment at 510.3 trillion rupiah. But here's the catch. This investment concentrated heavily in basic metal industries, mining, and transport. Sectors that boost GDP through capital intensity rather than job creation. The result, 22,671 manufacturing jobs lost out of 42,385 total layoffs, even as manufacturing output grew 5.68%. That's the productivity paradox in action. Exports rose 10.67%, driven partly by front-loaded shipments ahead of anticipated U.S. tariffs. more cyclical than sustainable. Meanwhile, government spending fell 0.33%, signaling fiscal retreat just as monetary policy began easing. Then came the social reckoning. August 10th, over 100,000 people protested in Pati Regency, Central Java, against a proposed 250% increase in land and building taxes. The protests forced the government to cancel the hike, exposing what CSIS calls a crisis of fiscal legitimacy. August 15th, 365 students in S region fell ill after consuming school lunches. National outrage over public spending oversight followed. By August 25th, protests had spread to Jakarta, Bandung, and Surabaya, triggered by plans to raise parliamentary allowances. These escalated after a delivery driver was killed by a police vehicle, channeling public anger toward elite privilege. Market response was swift. August 29th, Jakarta Composite Index plunged over 2%, rupiah weakened nearly 1%, prompting Bank Indonesia intervention. Social stability had become an economic variable that markets actively price. The policy framework reveals fundamental incoherence that explains why record investment fails to generate broad-based prosperity. August 19th to 20th, Bank Indonesia cut the buy rate to 5%. Their reasoning? Mild deflation with headline CPI down 0.08% month-on-month and subdued core inflation at 2.17% year-over-year. This marked BI's fifth rate cut since September 2024, taking rates to their lowest since late 2022. But this easing follows what Denny Frywin describes as pushing the gas and the brake at the same time, a policy contradiction that creates a liquidity trap. Here's the mechanism. Fiscally, the government maintains high spending on populist programs, financing deficits around 2.5 to 3% of GDP. To fund this, BI has purchased over 1,600 trillion rupiah in government bonds, about 8% of GDP, effectively monetizing part of the deficit. But simultaneously, here's the contradiction. BI sterilizes this liquidity through reverse repos and SRBI instruments to prevent inflation and protect the rupiah. Net effect: fiscal expansion offset by monetary sterilization. Money exists in the system but doesn't circulate effectively. Banks remain risk-averse despite abundant liquidity. Credit growth slowed to 7.3% year-over-year in July, down from 11.7% in July 2024. This explains the productivity paradox. $57.38 billion in investment generates strong GDP growth but weak employment because money flows toward capital-intensive sectors while credit for labor-intensive businesses remains constrained. Even with BI's recent easing, real wages stagnate, household consumption stays restrained, and 59.4% of employment remains informal, limiting both social protection and productivity growth. The manufacturing job losses tell the deeper story. Despite a global commodity boom and record investment, Indonesia lost manufacturing jobs because growth concentrated in automated mineral processing rather than labor-absorbing production. This represents a structural shift that risks widening inequality even as GDP expands. Now, with inflation controlled and the rupiah stable at an average 16,445 per dollar in August, BI finally has room to stimulate. But the fundamental question remains: will lower rates translate into real economy credit growth, or will structural bottlenecks and policy incoherence continue limiting transmission effects? Sectoral data reveals the productivity paradox in stark detail. Manufacturing PMI rebounded to 51.5 in August, first expansionary reading after 4 months of contraction. Production and new orders improved across food processing, textiles, and automotive. But with 22,671 manufacturing jobs lost in H1 2025, over half of all layoffs, this recovery is clearly capital-intensive rather than labor-absorbing. Investment data explains why. Top FDI sectors: basic metal industries at $3.2 billion, transport warehousing, and telecommunications at $2.1 billion, mining at $1.8 billion. These sectors generate high GDP growth per dollar invested, but create relatively few jobs per unit of capital. Agriculture shows the volatility of resource-dependent growth. After surging 23.4% in Q1, it slowed sharply to 1.65% in Q2. Rice output rose 14%, but the S-Region school lunch incident exposed weaknesses in distribution and quality control. Production gains don't guarantee safe delivery to consumers. Services grew 11.31%, led by information and communications at 7.92% and trade at 5.37%. Notably, NPISH, nonprofit institutions serving households, grew 7.82% year-over-year. This suggests civil society organizations are filling gaps in public service delivery as government spending retreats. Construction grew only 4.98%, with construction price indices accelerating 0.27% monthly. This indicates emerging bottlenecks in infrastructure despite reduced government spending. Mining managed just 2% despite high commodity prices and massive investment inflows. Capital is flowing in, but it's not yet translating into broad-based economic activity. In digital economy progress, we see advancement, but geographic concentration persists. Microsoft's Azure Indonesia Central Region is operational, supporting the $1.7 billion investment positioning Indonesia as a Southeast Asian tech hub. Google's AI Accelerator helps startups access machine learning tools, boosting innovation in fintech, agri-tech, and health tech. Fintech and e-commerce growth benefits from Buy Fast, which has reduced transaction costs. Startup funding reached $350 million in Q3, focused on logistics and fintech, sectors addressing real infrastructure gaps. But digital adoption remains Java-concentrated. The Palapa Ring project expands rural connectivity, but last-mile access stays challenging. Without deeper reforms in tax administration, labor flexibility, and logistics, digital growth risks remaining islanded, unable to transform the broader economy or address the fundamental productivity paradox. The corrected investment figures reveal a far more dramatic story than initially apparent. Total realized investment of $57.38 billion in H1 2025 represents extraordinary capital inflows by any standard. The balance split: FDI at 45.9%, DDI at 54.1%, demonstrates both international confidence and strong domestic investor sentiment. But geographic and sectoral concentration explains why this doesn't translate into broad-based job creation. Investment is shifting eastward, responding to government incentives, supporting territorial development objectives. However, it's concentrated in natural resource downstreaming, battery manufacturing, mineral processing, other capital-intensive value-added activities. Singapore and Malaysia topped foreign investor lists, reflecting continued ASEAN integration. China and Japan remained major sources, demonstrating Indonesia's ability to attract capital across geopolitical divides. The external position remained remarkably robust. July's trade surplus of $4.17 billion contributed to a cumulative January-July surplus of $23.65 billion. Export growth of 9.9% year-over-year was impressive given global uncertainties. The 5.9% decline in imports reflected both demand management and improved production efficiency. Non-oil and gas exports led performance. Palm oil, coal, and mineral ores benefited from strong international demand and Indonesia's competitive positioning. This export diversification reduces vulnerability to single commodity swings. Foreign exchange reserves of $152 billion provided 6.3 months of import cover, demonstrating capacity to manage external shocks. The rupiah averaged 16,445 per dollar, maintaining competitiveness while avoiding excessive depreciation. Globally, U.S. tariffs on Indonesian exports eased to 19% in early August. Significant improvement, reflecting successful diplomatic engagement. But major economy monetary policies continued creating volatility in capital flows, requiring continued vigilance despite Indonesia's strong fundamentals. China's economic performance remained crucial given close trade relationships. The global energy transition presented both challenges and opportunities. Indonesia's critical mineral resources position it well for renewable energy infrastructure and EV battery supply chains. But this requires continued strategic investment to capture maximum value. Bank Indonesia's August 19th to 20th rate cut to 5% represents more than technical monetary policy. It signals recognition that the previous approach was creating a liquidity trap. Economic justification was clear. Headline inflation at 2.31%, core inflation at 2.17% provided ample room for easing. BI also cut deposit and lending facility rates and relaxed reserve requirements to inject liquidity directly into banking systems. Market reaction was immediately positive. Jakarta Composite Index rose, bond yields declined, rupiah stabilized. It demonstrated BI's technical competence and forward-looking approach. But the deeper significance lies in addressing policy incoherence that has constrained growth transmission. For years, BI has been monetizing fiscal deficits through massive SBN purchases, while simultaneously sterilizing the liquidity impact through reverse repos and SRBI instruments. This created a fundamental contradiction: fiscal stimulus offset by monetary neutralization. Government spent to stimulate demand, but BI ensured the money didn't actually circulate in the real economy. Result: credit growth declining to 7.3% year-over-year despite abundant system liquidity. Banks remained cautious. Businesses couldn't access credit. Households faced stagnant real wages, limiting government spending impact. BI's pivot toward easing represents an attempt to break this cycle. But success depends on overcoming structural bottlenecks. With 59.4% of employment in the informal sector and regulatory constraints limiting business expansion, lower rates alone may not stimulate broad-based credit growth. Deflation risk adds urgency. If consumers and firms delay spending anticipating lower prices, weak demand could become self-reinforcing. Exactly what happened in Japan during its lost decades. BI's rate cut was necessary but not sufficient. To truly stimulate the economy, fiscal and monetary policy must be actively coordinated rather than working at cross purposes. The real test: will this easing cycle translate into real economy expansion or merely financial asset revaluation? Amid domestic turbulence, Indonesia executed 3 strategic breakthroughs that collectively represent a coherent response to global economic headwinds. The Indonesia-Peru CEPA, signed August 11th, transcends traditional trade agreements. Peru offers a gateway to Latin America through 22 active trade agreements, including CPTPP membership. Crucially, Peru's Chanque port, a joint project with China's COSCO Shipping, provides direct 22-day shipping to Shanghai. That's faster than Europe to Indonesia routes. This isn't just market access, it's geopolitical diversification. As U.S.-China tensions persist, Indonesia gains access to Latin American agricultural exports and a logistical bridge that bypasses traditional Western-dominated shipping routes. The timing, amid tariff uncertainties, demonstrates strategic foresight. The Abadi LNG project represents energy security and climate leadership combined. The $20.94 billion investment by INPEX entered front-end engineering design phase, targeting final investment decision in early 2026. Key strategic elements: 9.5 million tons annual LNG production for domestic energy security, carbon capture and storage technology from project inception, $150 billion projected GDP contribution, and 70,000 jobs over 30 years. Third-party CO2 storage services, creating new revenue streams. This positions Indonesia as a leader in clean LNG production while securing energy independence, crucial as global energy transitions accelerate. Local currency transactions expansion accelerated significantly. With China, LCT volumes at Bank ICBC Indonesia more than doubled in H1 2025. With Japan, bilateral LCT reached $5.1 billion by July. The QRIS cross-border payment system now allows Indonesian tourists to pay directly in rupiah in Japan. This financial de-dollarization reduces foreign exchange costs, shields the economy from US dollar volatility, and democratizes strategic financial tools by extending benefits to small enterprises and consumers. Together, these initiatives, trade diversification, energy security, financial sovereignty, form a coherent strategy for reducing external vulnerabilities while building long-term resilience. They represent Indonesia's evolving approach to strategic autonomy in an increasingly multipolar world. The proposed 2026 budget represents a high-stakes attempt to address policy incoherence, but carries significant social and economic risks. Central government transfers to regional governments will drop from 919 trillion rupiah to 650 trillion rupiah, a massive 29% reduction. Government frames this as promoting fiscal discipline and strategic reallocation toward national priorities with higher multiplier effects. The logic is compelling. Redirect savings toward infrastructure, human capital, and green energy while forcing regions to become fiscally independent. A new productivity-based budget allocation framework aims to ensure spending generates maximum economic impact. But the paddy tax protest reveals dangerous dynamics this creates. When central transfers decline, regional governments must raise local revenues, often through unpopular tax increases that trigger social unrest. August protests demonstrated how quickly fiscal pressures escalate into political crises, affecting market confidence. Critics warn this could disproportionately affect poorer provinces dependent on central funding for basic services like healthcare and education. Without adequate preparation, the policy risks creating a feedback loop of economic frustration and social instability. Energy security planning focuses on preventing LNG supply disruptions through integrated systems. Gas aggregators will pool supply from various sources, absorbing surplus and releasing reserves during shortages. Gas integrators will synchronize the entire value chain from terminals to distribution. This approach is essential for shielding domestic industries from global price volatility and ensuring reliable supply as the Abadi project comes online. Recent August supply disruptions underscore the urgency. The EU-Indonesia CEPA, expected for ratification by late 2026 or early 2027, presents opportunities but requires preparation. The long transition period risks losing momentum. Indonesian small and medium enterprises must ready themselves to meet EU sustainability and quality standards. Without targeted support for certification, compliance, and market access, UMKM could be left behind as larger firms capture deal benefits. The preparation window is now. Several key indicators will determine whether Indonesia can sustain momentum or face correction. September 5th CPI data will show whether August's mild deflation persists or food prices, up 4.47% year-over-year, push inflation higher. This directly affects BI's next policy meeting September 25th to 26th, where another 25 basis point cut depends on inflation and rupiah stability. Manufacturing momentum requires confirmation. 1 month of PMI expansion encourages, but 3 consecutive months above 50 would confirm genuine recovery. Watch for production, employment, and export order data indicating whether capital-intensive investment is beginning to generate broader economic activity. Social stability has become a core economic variable. Government must address public anger over parliamentary allowances, food safety, and corruption. KPK investigations and any policy reversals on taxes or subsidies will directly shape market sentiment and investor confidence. The 2026 budget implementation will test whether regional governments can attract investment and manage reduced central transfers responsibly. Early indicators of local tax increases or service cuts could trigger renewed social unrest. External risks persist. U.S. trade policy shifts, Chinese demand changes, global commodity price volatility will impact Indonesia's trade balance and fiscal health. The $57.38 billion investment inflow creates positive momentum, but also increases exposure to global capital flow reversals. Bank Mandiri projects 2025 growth at 5%, with inflation at 2.4%, potentially rising to 2.6% in Q3 if food price volatility continues. The key uncertainty: whether record investment flows can finally translate into broad-based job creation and income growth. August 2025 revealed Indonesia trapped in what CSIS researchers call a stable but stuck equilibrium, growing but not transforming. Record $57.38 billion investment created impressive GDP growth, but the productivity paradox meant 22,671 manufacturing jobs were lost even as output expanded. Policy incoherence between fiscal expansion and monetary sterilization created a liquidity trap that weakened transmission mechanisms. Social unrest demonstrated that public trust is now a core economic variable that markets actively monitor. Yet strategic breakthroughs: the Peru CEPA, Abadi LNG project, LCT expansion, signal Indonesia's capacity for forward-looking resilience building. To escape the middle-income trap, Indonesia must coordinate fiscal and monetary policy toward shared objectives rather than working at cross purposes. Address the productivity paradox by supporting labor-intensive sectors alongside capital-intensive downstreaming. Restore fiscal legitimacy through transparent, accountable governance that addresses inequality concerns. Deepen global value chain integration beyond raw material exports toward higher value manufacturing. The 2026 budget represents a crucial test. Can Indonesia redirect resources toward productivity-enhancing investments without triggering social instability that undermines the entire growth model? The challenge isn't managing crisis. It's transforming stability into dynamism and growth into shared prosperity. Thank you for joining Monthly Indonesia Economy Focus. Next month, we'll track whether manufacturing recovery sustains, how government manages social tensions, and whether record investment finally translates into the broad-based job creation Indonesia desperately needs. Stay informed, stay critical, and stay engaged.